Good morning, everyone. We'll be getting started in a couple moments. Thank you. Good morning, everyone. We're going to give it that customary couple of moments while folks are entering the waiting room, so just bear with us a moment. Thank you. Thank you for that, Michael. If folks want to introduce themselves in the chat box, they're more than welcome. Hope everyone's having a great spring. And it's home buying season, right? So it's a great chance for us to learn something about that this morning. We're just having folks join now, so we're just going to give them another moment. Great to see you all this morning. Thank you so much for being with us. You're going to learn a lot. You'll be very glad you came. Good morning, everyone. We have a couple more folks that have just joined. If you want to go ahead and add your information, we'd love to hear from you. Thanks, everyone. We're just going to give it another moment, and then we'll get to hear some great introductions. Thanks all for being here this morning. You're going to learn a lot. Good morning, Sue. If folks want to introduce themselves in the chat box, please go right ahead. It's great to be here this morning. We're going to learn so much wonderful information. And we're just going to give another 30 seconds, and then I'll be turning it over to our president and CEO for a warm welcome. All right, I don't have anyone in the waiting room at the moment, so I'm going to take that off. Oh, just kidding. One more, and then two more. Okay, great. So I'm going to go ahead and introduce Jeannie Montano, our president and CEO, who's going to give us a warm welcome this morning. Thanks everyone for being here.
Thank you, Melissa. And it's great to see everyone this morning. I want to welcome you to this financial literacy workshop that's going to be focusing on road to home ownership, being prepared and creditworthy. And I know I say this every time, for my staff have heard this, but I wish I had this before I bought a home. You're going to learn so much today. But you know, the United Way really wants families in Dutchess and Orange counties to be financially stable and independent. We work to improve access to resources to alleviate short-term financial crisis in order to increase local families' economic positions. We also have the Cash Coalition, which provides free tax prep services to low and middle income residents. And we provide, education through financial literacy programs just like this that you're going to see today. So we have, these literacy workshops that really bring, banking professionals to speak to you. And, they have such great expertise. So we're really excited about that. So we're pleased to have with us today Mike Delgado. He is a mortgage loan originator at Rhinebeck Bank, and we work very closely with Rhinebeck. Thank you, Mike, for sharing your expertise. Like I said, it's certainly welcome because, as we move towards summer, which is a very active home buying season. So, and I want to thank everyone who attended today. Also, you will be eligible to get $550 off closing costs with Rhinebeck Bank, which is very exciting. I didn't have that either. So it is. Right. It is most helpful at this time with inflation and financial uncertainty. It is very welcome. But I would also be remiss if I didn't thank my wonderful staff, who helped put these things together, especially Deirdre Sepp, Melissa Clark, and Sam Lowe. So right now, I want to thank you all for coming. I hope you learn a lot this morning. And with that, I'm going to turn it over to Deirdre. Thank you.
Thanks, Jeannie. Good morning, everyone. Glad you're here. Just a couple of housekeeping tests before I introduce our speaker. The presentation itself will be about 45 minutes long, and then there will be a Q&A for the final 15 minutes. You may either hold your questions until the Q&A, or you can put them into the chat box. I will be making sure that I will read out all questions that are entered into the chat box. Also, this presentation will be uploaded to the United Way website afterwards. So if you missed anything, you want to go back and take a look at it again, or you have a friend who wasn't able to be here, it will be available to you that way. I have put our speaker's name and contact information into the chat. It's at the very top of the chat in case you want to get in touch with him afterward. And by the way, I got a sneak peek of the presentation. It's very good, and I also wish I had had this kind of a presentation before I purchased my first home. So without any further ado, it's my pleasure to introduce to you Michael Delgado, who is mortgage loan originator at Rhinebeck Bank. Mike has more than 35 years of experience in the real estate and mortgage industry. He has diversified knowledge of many first-time homebuyer mortgage products and the core requirements needed to obtain loan approval. So thank you very much for being here, Michael. I'm handing it over to you.
Okay. All right, well, let's get the presentation kind of set up. And what I'm going to do is I packed in a lot of information for you. I'm going to try to run through this. It's pretty ambitious and stuff, but I wanted to give you as much information as possible. And at the end, we'll be able to answer any questions or try to answer any questions that you have. Okay. Let's go to the first slide. Go ahead, keep going. We'll move along. Okay. What I did is, like I said, there's going to be a lot of information here, but this first slide is really important because really what this does right here in a nutshell is give you some of the criteria or the criteria that's really required in mortgage originating and to help you to get a home. We're going to dive into these guys in detail, but what I want you to realize is you can always go back and just keep it simple and just understand that these are the critical components. I call them the pillars in order to get a loan approval. the focus is going to be if any of these are off, you basically what any loan originator is going to look for is income, assets, credit, and what they call collateral. So what happens is if any of these things are off, then basically what happens is your loan is going to be off, or your ability to qualify for a loan. So for example, you may have a great income. You might even have good savings, but if you're, if I get somebody with a credit score of 400, we're going to be in trouble. I may have somebody who has fantastic credit and they have good income, but they have $500 in the bank. There are some things that we're going to talk about to help you, as far as, programs that are available or different things that we can discuss. But again, the days where, except for like a veteran's loan, but even then you'd have to get a seller to be willing to give you a seller concession, or sometimes there's a USDA product and stuff, but most of the time you have to have some skin in the game. So what happens is if any of these components are off and stuff, then what happens is your ability to qualify is going to be off. So that's why we're going to talk about it. The thing with closing costs is there's going to be some simple rules that we can discuss. And a lot of times people are shocked when you tell them, they'll say, I have X amount for a down payment. And my next question to them is, how much do you have saved up for closing costs? And and I'll kind of like, they'll look at me and say, well, how much do I need? And I'm going to give you a general idea and stuff, but think of buying a home as two parts. One is going to be your down payment, and the second part is going to be the closing costs. And those are the two things that you're going to need. Once you understand the criteria of the income, assets, credit, collateral, then you're going to be in a position to better understand what mortgage program best suits your needs. So you'll understand this as we go along, because rather than dive in and say, oh, let's talk about Sunny May or Home Ready and stuff, you really need to know whether you're going to qualify for any of those programs and which one best suits you. All right, go ahead and let's go to the next slide. So with any with any profession, whether you're a doctor, an attorney, a mortgage originator, what happens is a lot of times when you have a tendency to find out that they each have their own language, their own, acronyms and stuff. And mortgage originators have a tendency to do this too. They'll sit with you, you'll sit down and talk to a person and they'll say, oh, your DTIs are too high, or what do you want your LTV to be and stuff. And what I often find is when you look at people, they'll stare at you because you're used to and accustomed to those acronyms, but they're not. So this is really great for you, because what happens when you sit with anybody, they're going to look at you and be quite impressed if you can understand what a lot of these terms mean and where you stand. So what I want to do is talk about, and there's not a lot of acronyms, and these are pretty much a lot of the critical ones. Okay. So the first thing that you're going to hear is, and what I'm going to do is I'm going to go to loan to value first. So you'll hear like loan originator might turn around and say, what do you want your LTV to be? So I'm going to simplify it rather than take the definition and basically say, let's say we have $100,000 mortgage, and you're going, for example, for a Sunny Mae mortgage will allow you to put down 3%. So what that means is you're borrowing from the bank 97%. That's how much of a mortgage, and that's how much money you're taking. So your loan to value, meaning how much you're borrowing based on the purchase price, would be a 97 LTV. If you put down 5%, it's a 95 LTV because you're borrowing 95%. So that's as simple as it is. If you put down 10%, you're borrowing 90%. So you understand that your loan to value is 90%. So that's basically what it means is how much the number that's associated with the loan to value is how much you're asking the bank to lend you. The second term, which is important, is called DTIs. And this happens a lot because what happens is as someone's inputting your information and they're getting your assets and they're getting your income, and they look at your credit and they look at how much debt you have, there are percentages that are looked at. And each loan program has certain criteria that they're given from the Federal Reserve. And they're saying, hey, we don't want what you're going to pay for a loan to be more than X of your income and stuff. So let me explain it this way. What debt to income means is there are two percentages that you will always hear, a top percentage and a bottom percentage. The top percentage means that they don't want, lenders or the Federal Reserve and stuff, it's kind of like a fail-safe. They don't want what you're going to pay for a mortgage every month with taxes, insurance, PMI, and everything to be more than 40%. For example, on a conventional mortgage, 40% of your gross income. So what that debt to income ratio, the top percentage, reflects just the mortgage, and each loan says, hey, we don't want you to pay more than that. Now you may wonder where they come up with that number. So for example, with conventional, the 40% number means, hey, we know that after you buy a house, you got to be able to eat, you got to be able to pay your electric bills, you got to be able to pay for gas, you have to be able to live. So the comfort zone here with these loans, and kind of feeling that, you're safe and you won't get in trouble, is, we don't want that percentage to exceed that amount. Now there's a second percentage on what's on debt to income ratio. And for example, I'll use a conventional mortgage, it's 45%. What that means is when the credit report is pulled and we see what your debts are, you got car payments, credit card debt, student loans, things like that. They'll add that monthly amount onto the mortgage payment, and they don't want what the mortgage payment is going to be with everything and all your debt to exceed that percentage. So, for example, with FHA, they're a little bit more liberal with that, and they'll go to 56%. What that means, you'll have more buying power, and it'll allow you to borrow more money. But a lot of these programs are all designed to kind of like have those fail safes. And a loan originator, as they're inputting your information, you'll hear the term, hey, your debt to income ratio is X, and your front ratio is this, your back ratio is that. So all that means is that the amount that you're paying is this percentage of your income, and with debt, that's the lower percentage. Okay. A lot of times people will ask, what is my payment, my monthly payment? And, so you might hear a loan originator say, all right, your pity is X. What that means is principal, interest, taxes, and insurance. So a lot of times as you're inputting the information, you're calculating, it's easy to calculate, for example, on 100,000 mortgage as X percentage, they're going to see what your principal and interest payment is. But in order to qualify for the mortgage, they'll do an estimation of what your homeowner's insurance is, property taxes, and you're going to pay for home, and there's an additional insurance that is called PMI. Now, what PMI, private mortgage insurance, means is that ideally, some people, and a lot of people think that they have to put 20% down. They don't. Almost every single program that we're going to discuss later lets you get into a house with 3% down, 5% down as a minimum down payment. However, lenders are told, okay, we'll let you lend somebody up to that 97% or up to 95%, but we want an additional insurance in the event of default. And that's called private mortgage insurance, and it protects the banks up to a certain amount in case somebody was to default on the loan. So that gets added onto your mortgage. What I'm going to say about PMI very quickly is this, is that except for FHA, once you get to 20% equity, and actually in New York, it's 78%, okay? Once you have 22% equity in your home, that PMI goes away. And if you do nothing on a mortgage, what's going to happen is it usually takes, honestly, about 10 years. However, with the way prices are moving and things are going on, if you were to pay extra, or you felt that your property value increased, New York State allows you to go to the lender and say, let's say 2 years went by and you feel, hey, my property value has gone up, I paid a little extra, I've got that equity. It's good for you to know that you can call your loan servicer and say, I I'm fairly confident that I have more than 22% equity in my home and I want to get that PMI removed. And that's good for you to know because a lot of people don't realize that. And, and you have the ability to do that. So when you hear pity, it really reflects all the payments that are going to be involved in your mortgage. So originally, as a loan originator is doing their numbers, you may not have picked a home yet. So they're going to say, okay, in this area, the average taxes are $7,200. So I'm going to plug in $600 and stuff, and they're going to work the numbers to try to make it real. Trade lines. Now, this is a fun one because basically what happens is when you do your credit report, a lot of times what's going to happen very quickly is that somebody's going to look at the credit report. They might see you only have one credit card debt, and somebody's going to say you don't have a lot of trade lines. You only have one item, or you have a lot of trade lines here, and therefore your debt to your DTIs are very high and stuff. What trade lines basically means very simply is that when the credit report comes up, it's what are the items. Trade lines just means that, what are the items or debts that you have. And the reason that's important as a first-time home buyer is because ideally, and we'll talk about that in a minute, they like you to have, banks want to see if they're going to lend you money, that you have the history of having debt and paying that debt, hopefully on time, without any issues. And ideally, they like to see that you have 3 trade lines. In other words, a car loan, a credit card, a student loan, something that you've been paying on a consistent basis for a period of time. But that's all that trade line means. It means that, the debts that are reflecting on your credit report. And the last term that you're going to hear is collateral. What collateral really means is a house. It just means that is what the bank is, they're lending you money based on that item, based on that home. That's the collateral. And we're going to discuss that, as far as conditions and stuff and what that means. Okay, next slide. All right, so we said these are the foundations: income, assets, credit, collateral. We're going to dig deep into them, all right, and move along. All right, so go ahead and go to the next slide. So keep going. So then what's important about income, we can move to the next one, is this is one of the first things. So I want to, and this is good because what happens is obviously you have to have a job, you have to have employment. So what is it that a loan originator is looking for? So if you're an employed individual, you're going to hear somebody say, I'd like to see your 2 years of W-2s. And the reason for that is because you need an employment history. And for most mortgages, they want to see that you have at least 2 years. There's a workaround on that on a couple of things and stuff, but you have to show that you have what's called a stable employment history. And the way they establish that is show me that you're working somewhere for at least 2 years. And the W-2s are important because sometimes people have, like, for example, recently I've had some nurses and stuff who were looking to buy a home, and they have their income was like kind of erratic all over the place. They have shifts, they have night differentials, everything and stuff. And sometimes the W-2s just helps you see, okay, this is what the annual income was for the past 2 years, and they can average that and use that as well. They always want to see current pay stubs. And, for example, with Sunny Mae, when you put a loan in and you're doing a pre-approval, they're going to go by what your current year-to-date income is. So a lot of times we need the pay stub because that'll tell us. And a lot of times on the pay stub, what's reflected is what your base salary is, what overtime is, et cetera, and that's why we need that up front. In the 2 years of federal tax returns, sometimes there are just certain jobs, sometimes union laborers and things that it's just easier to take a look and see how the income was being reflected on that. Sunny Mae, for example, will ask you for 3 years federal tax returns. Now, the reason they do that, and the reason we might ask for it on a Sunny Mae mortgage, is because they want to see on the tax returns that you're truly a first-time home buyer and that you're not, that on your tax returns there were no credits or home information on there. And that's basically the proof for them that you're a first-time home buyer. So consistent annual income, like I said, is an average of 2 years. They'll look at a year-to-date analysis. And then there are a couple of other things that might count. So, for example, if you're receiving child support, if you're receiving it, that can be used as income. If you're receiving Social Security benefits for children and stuff also, by the way, that can also be added in. So there are some factors, some other additional income types that can be added in. And a lot of times a good originator will ask you and say, is this it? And just go through it with you. Okay, go ahead, next slide. All right, with self-employment, this is important. There's a couple of things. Usually with self-employment, if you are a DBA and you're not a corporation or an S Corp, on your personal tax returns, there'll be a Schedule C. What the Schedule C is, on the top, it'll say profit and loss. So on that page, it's important because, we'll be able to see that somebody is self-employed and this is what their income is. If you are self-employed and you're a corporation, an S Corp or a C Corp, what you'll find is we'll ask if the business is less than 5 years old, they'll ask for 2 years of business tax and personal tax returns. What I wanted to say to you about, if any of you are self-employed, here's the important part. And I get this from a lot of people from all kinds of professions. What's important to understand on self-employment is that it's never the gross. All right. Many times I'll get people to say to me, I have a construction business and I made 250,000 last year or 300,000. What happens is with personal employment, the only thing that the bank can use and the only thing the government cares about is what is the income that you're paying taxes on. It's called the adjusted gross income. And that's why we asked for that with income, because what happens is I can get people who say they make $500,000 a year and they write everything in the kitchen sink off because they've got a great accountant. But the problem is that if the bottom line income that you're paying taxes on is $35,000, that's the income that we have to use in order to qualify you for a mortgage. So sometimes, like, for example, I had a lot of people because, their taxes weren't done yet. Their 2022 or 2021 taxes were on the lower end. And I told them, look, if you want to really buy a home, you're going to have to bite the bullet this year. You're going to have to show and report more income, pay more taxes, because the only income that we're able to use is basically that net adjusted gross income. Okay, next slide. All right, so other important items is, like I said, when both Sunny Mae conventional mortgages say that they're looking for a 2-year job history. Okay, if you change a job, and believe me, this has happened in my lifetime. If what you want to do is while you're buying a home, don't quit your job. Or if you do quit your job because you got a better offer, just try, don't go from like basket weaving to being the CEO of Amazon or something. But what I'm saying to you is they like to see that you're kind of like moving along the same lines. I had a guy who was he was a security person, security in IT. He was working for one firm and he left. He got a raise, got a good raise and stuff, but it was the same line of work. So what happens is sometimes what they want to do is if there is a recent job change, they just want to see that you're moving along the same lines. If there are employment gaps, a lot of times that happened during COVID and stuff, you're going to need explanations, but there's a reasonable period of time that they're kind of looking there, usually 3 to 6 months. If you have, like, it might have been a medical issue, and a lot of times what an underwriter will say is, give me a letter of explanation as to why between X and Y there was a break. Like I had one guy actually recently doing a Sunny Mae with me, and he had 1 year employment history, and the year before he wasn't working, but it turned out he had a motorcycle accident. He was in the hospital for months. He was able to document it, and they actually gave me the green light for him to move along. So there are times that you can do that. There are rules changes, other ones that are really good too. If you're going to school, for example, to be a nurse or to be some kind of a tech, whether it's a mechanic or something, and you can show what would happen is, let's say you graduated, even a couple of months went by, and now you got a position in a hospital, for example, or somewhere else, but it was in the field that you had gone to school for. So, for example, if you went to school to be an accountant, you graduated, you're scouting around, trying to get a job, you finally landed one as an accountant. Your time in college will act as part of that 2-year history. So what they will do, what we would do is say to you, give us a copy of your transcripts and your diploma to show that this was your field of expertise and you landed a job in this position, and we're able to fill in that 2-year gap and make it work. Teachers, business contracts, and of course, I've had, for example, even doctors that graduate med school and they're going in as an intern and they just started. So, and sometimes people will graduate and then all of a sudden what they're looking for is really stability, is to feel confident that the job you got, you may have just landed it and stuff, but this is going to move along. So sometimes there are like state contracts and stuff that say, or sometimes people have contracts say, okay, good, you're hired. This is your salary. We're going to move along. This is a full-time position. It's for X amount of dollars, and we're able to make it work. Okay. All right, next. All right, so assets. Let's move on to that. So the next thing, what happens is, so now I know your income and stuff, and assets is important, because what happens a lot, for being a first-time home buyer is hard. The money is crazy. I mean, you have to put down 3% or 5% on these loans, and you have closing costs on top of it. And a lot of times, these things can add up to 15 to 25,000 as a first-time home buyer. And so what happens is we have to have a base point. We're going to talk about, what are the avenues that we have? So the first simple question is going to say, okay, how much money do you have to work with? So one thing that originated is kind of like always smiling, and people say, well, how much do I need? So that's not really what I asked you. What I'm asking you is, how much do you have, to work with? Because we could, at least that gives me a base point for where we are. And if there are other suggestions that I can try to give you to help you. So we're going to say, okay, do you have any savings? Do you have any checkings? Because what the bank's looking for is, what kind of liquid assets do you have to get started with? Do you have enough in checking and savings? Sometimes people work and they have IRAs, or they have stocks, or they have 401ks. So sometimes, somebody might say to me, hey, I have $4,000 in the bank, but I have $35,000 in a 401k. So you can obviously, sometimes with 401ks, each plan is a little bit different. Some of them allow you to draw the money, but because it's being used for a house, a lot of the unions will turn around and say, give us a copy of the contract. You're able to withdraw the funds, and there's not going to be any penalty. Sometimes with 401ks, you can take the money out and there's a 10% penalty. So it depends on each company, and you want to take a look at that. But the point is, with those things, is they're not actually liquid at the time until at some point in the transaction, they're going to want you to withdraw those funds and put them into a checking account. But to start you off, if you can show that you have any of those things and that those things will cover the down payment and closing costs, that's good. Okay. So if you don't have enough money in checking and savings, and you don't have a 401k, then the question is, okay, how am I going to fill in this gap? So on the right side, there's some suggestions. One, I always tease, they put financial gift here, and I call it, do you have any rich uncles or aunts? All right. And the truth is a lot of times with families, a lot of young people who get started in their first time home buyers, they know it's a hard pocket. So parents jump in. A lot of times family, aunts, uncles do jump in and help. And just so you know, the gifts are unlimited. They can give you however much they want. All right. What I am going to say to you about gifts, which is good for you to know, is that, a lot of times people hear the term, like, for example, hey, you're only allowed to give an annual gift of $15,000 a year. That's true. But this part is funny. The IRS has a regulation that for each individual, they're allowed to give a gift in a lifetime of $5 million. Okay. So what that means is, if you needed 20,000, all it means is that for them, if they give you a gift, the accountant's going to fill out an additional form that they don't pay taxes on. They're just going to fill out an additional form that says, that extra 5,000 was part of their $5 million bucket. And the reason I'm mentioning this is because sometimes parents are nervous about it and stuff, but you know, there is a good, you know, this is a great avenue, and obviously I'm going to tell you probably one of the most used avenues for a lot of the first-time home buyers. Okay, and there's no limit on how much of a gift somebody can give you. The other thing is, very quickly, I want to try to tell you is I've had several situations where somebody is either buying their grandmother's home or something like that, and the family wants to give it to them, and they're letting them get it at lower than what market value is. So I'll give you an idea. Somebody had a house that was probably actually worth about $300,000, but the family said, okay, what we're going to do is we're going to sell it to you for $250,000. And what we're going to say is you don't have to put any money down. We're going to give $50,000 as a gift of equity because the equity is in the home. We're going to give that gift to you as a gift, and all you got to do is get a $200,000 mortgage and come up with the closing cost. So a gift of equity is another tool that sometimes people have, and it also is a great way to avoid PMI if you're in that situation. Seller concessions on conventional Sunny Mae loans. If you put 3 or 5% down, the seller is allowed to give you up to 3% towards closing costs. I'll try and ram through this real quick, but what happens is this is a tough market for it. Houses are really kind of moving and they're competitive. And so, I mean, in a market where it's more of a buyer's market than a seller's market, you have a tendency more to see that. But it's just, I want you to realize that the seller is allowed to help you towards closing costs. You can request that. You can say, hey, I'm doing a Sunny Mae mortgage. They'll allow me to ask for 3% towards closing costs. I'd like to see if I can get that from the seller. It's tough right now, but it is. Sunny Mae has a great New York State program. Sunny Mae means State of New York Mortgage Association. And New York State says, hey, we know buying a home requires a lot of money. We will help you with 3% towards down payment or closing costs. If we do that, the only thing is right now, for example, the Sunny Mae rate is 5.625. They say, okay, look, we're going to give you the 3% to help you, but we're going to make the rate 6%. So kind of like it's a, you're not, and the thing that you want to know is you're not making payments on that loan. What they do is they create a soft second, and they expect you to stay in the house for 10 years. If you don't stay in the house for 10 years, they'll prorate the amount and to ask you to rebate some of it back. And very quickly, there are some great housing grants out there. I saw somebody on here before from Patstone. They're in Orange and Dutchess County. You have River Housing, you have Rubco, you have Patstone, and sometimes they have they have avenues to help you with some grants towards buying a home. Right now, there's a program from the Federal Home Loan Bank called the Home Buyer Dream Program, and that's a grant that's available that gets you up to, it's $10,000, but you have to go to the counseling agency and they'll give you $9,500 because $500 goes to them for their time and effort in helping you get it. They give you a home buyer certificate and do home buyer counseling. So you can always look into the housing agencies and see if there are any programs that can help you towards purchasing a home. Okay, so this is the asset part, and these are kind of like some other avenues you can use. Okay, next. All right, so we're going to go through credit. Now, credit is really important. What's a credit score? So I think this is what I want to say very quickly. When you do mortgages and they pull what's called a tri-merge. What that means is there are 3 giant credit agencies, TransUnion, Experian, Equifax. They're all going to give us a score, and the score that's used is the middle of the FICO score, and that's what they call. So what happens is there's a formula that kind of churns in the background based on how much debt you have, how you pay things. Do you have collections? Do you have any judgments or liens? If you're not and you're paying everything on time, your scores, the score ranges from 300 to 850. I haven't seen anybody with 300 score yet, knock on wood. But if ideally for conventional mortgages, you want to keep that, from a 650 range and higher. If you go less than that, you still have hope FHA will work with you with like a 580 credit score or higher, all right? But the lower your score is, all that means is that something happened. You had a situation where you were late on payments and stuff. You had gone through a medical situation and stuff. And what happens is, based on how you pay things, that's going to reflect on your score. So it's really crucial as you're getting ready to buy a home and you do things, really pay attention to that, monitor it. In my lifetime, I've seen some people make some crazy mistakes. They went on vacation and they just forgot to pay a $50 credit card. And it reflects as a 30-day late on their credit. And if you have young credit, believe me, the credit bureaus wallop you big time. All right, go ahead, next slide. The other thing I want you to know about credit as we move along is that a lot of us, it's good to take a look at, for example, Credit Karma. And I know a lot of us will have programs that, from, for example, credit cards and different things. I'll say, hey, we'll give you your credit score. Those are what they call Vantage scores. Now, sometimes they are close, but what they do is they try to mimic the kind of like the formula that FICO would use and a mortgage program would use. But so I just want you to be aware that a lot of times, sometimes I'll get people and say, oh, yeah, Credit Karma said my credit is 720. But when I pull the actual tri-merge, it's like 680, and I'll look and stuff, and it just means that they missed some things or they tried to do it, but it really wasn't what the formula would be. But it'll give you at least a gauge, kind of like where you're going. But I just want you to realize sometimes the two don't meet. So things that affect credit are payment history. That's really crucial. If you've been on time with everything, you're gonna see a great score. If you're late and you have young credit, they're gonna beat you up and you're gonna see like a 50, 75% points down. The number of accounts you own. Now, remember what I said, ideally, the bank's looking for 3 trade lines, okay? So if you don't have credit cards, it doesn't mean you have to go out, and spend $5,000 because you got a $5,000 limit. Ideally, what you want to do is use about 35 or less % of whatever available money you have, because one of the formulas is, let's say you had $10,000 in credit cards. So you don't want them to be maxed out, because if you are maxed out, that's going to make your score go down. If you're showing that you're using your credit card, what they feel responsibly, have low, a low limit based on the amount you can borrow, your score is going up. The length is important. Most mortgages want you to have at least a 1.5 year history. So sometimes I'll get people who want to buy a house, they went out and they got 3 things and stuff, but I'll look and their credit cards were only open 2 months ago. So sometimes that won't work, okay? So you want to try to get a 1.5 year history under your buckle on those things, all right? Things that could affect your credit score, believe me, collections, judgments, bankruptcies, short sales. So there are rules. Like, for example, foreclosures on conventional mortgage, you have to be 4 years out. And that includes short sales. FHA will do 2 years. Sunny Mae has been pretty good too lately. I think they're 2 years as well. All right. Bankruptcies will stay on your credit report for 10 years. Now, it doesn't mean you can't get a home, but it just means that with those, they'll want you to be out of bankruptcy at least 2 years. And then what they want to do is see if you landed back on your feet. And if you show that since then you've been responsible, what the underwriter will look for in the credit is, okay, certain amount of time has passed, the person hasn't been late, they're showing that they're being responsible with their debt and stuff, and all those things help. Okay. If the credit card balances are too high, that, remember what I told you, if you max out your card, it's going to hit you. And the last thing is, think about who you want to work with. The credit bureaus say they understand when you're looking for a home, you're shopping, and if you have a couple of credit inquiries within 30 days, it's not supposed to impact your credit score. Okay. So, but ideally, what I'm saying to you is, choose carefully, make up your mind who you want to go with, and see if you can always get the credit scores from that individual. Because if you do shop, you really don't want, sometimes I get somebody who you come to me, I'll pull the credit, I'll take a look at it. And, I've got a laundry list of banks that they went to. And what happens is that'll start to chop down your score. Okay. So just be careful with that. All right. Next slide. Okay. So those are the three reporting: FICO versus Vantage, I told you about, understanding your credit score and its impact, trade lines. Now, if you, boy, I wish I had more time. Holy mackerel. Traditional and non-traditional trade lines, okay? Traditional trade lines, all that means is like a credit card, a car payment, a loan from the bank, all right? Sometimes somebody might come to me, they might only have one credit card and the bank says, we ideally want stuff. Sunny Mae is, for example, really good at that. What a non-traditional trade line means is pick up the phone, call your utility company or something and say to them, hey, can you give me a letter that says I pay my I've been paying that payment on time for at least 12 months. Your car insurance, you call them up and they'll send a letter. It says, yeah, this person is paying their car payment insurance over a 12-month period in good standing. So you'll understand that and stuff. So what I'm going to fast track and just say, guys, you can always get a copy by federal law of your credit report on annualcreditreport.com. By federal law, they have to give you all three credit reports so you can take a look at them and it's not a hard hit, so that you can take a look at it, okay? They will understand some hardships in terms of medical things and, all right, but I think that's enough for credit because I want to keep you moving and stuff. All right, let's go on next. All right, so, don't borrow too much, pay on time, and pay, if you could pay more than the minimum, that's really good. All right, let's go to the next slide. All right, collateral. What I'm going to say, let's go ahead to the next slide. So this is just important. What collateral means is, banks are going to turn around and say to you, okay, what are you borrowing? What are you trying to buy? So we don't have time to go over renovation loans and stuff right now, but I want to say to you, conventional loan, even if let's do conventional in Sunny Mae. They use what's called a regular appraisal. A regular appraisal means that if you find a home, it could be even a 1920 house, a 1920 kitchen. If the kitchen cabinets are okay, the appliances are in working order, and there are minor cosmetics, it needs a paint job, carpets need to replace, you're okay with that. That's all right, that's understood. Now, an FHA mortgage is a little bit different because the appraiser gives them like a 6-page punch. They have a 6-page punch list of stuff they've got to go through. And if there's any peeling paint, any kind of work to be done, they will tag that and there will be a work order. That's why what happens is when you're out on the market right now, sellers are a little bit fussy about accepting an FHA mortgage. Some of them will do it and stuff, but what happens is they have this impression that I don't want to be told I got to fix up anything, but they are a little bit more fussy than a conventional appraisal. But, the thing is, like I had a guy literally that came to me for a conventional appraisal, and it was one of the boarded houses up in Newburgh, plywood windows, plywood door, ceilings falling down and stuff. And I said, not going to happen. Okay. So that's what, the bank basically is saying, what do you want us to lend you money on? And if something were to happen, can we recoup our money based on what that collateral, what that house is? Okay. Next. Okay, so closing costs. I want to say this to you. So here, I'm going to give you a simple rule of thumb. Good, to the next slide so that we can roll forward on this. One is you have your down payment. That down payment is either going to be, like I said, on Sunny Mae mortgage, Home Possible will do 3%. Conventional mortgages will do 5%. Okay, so that's your down payment. Here's what I always tell people with closing costs. These are all the things that are involved. Closing costs are broken into two parts. Basically, there are some bank fees that involve the origination fee, the appraisal, the bank attorney fee, the credit report. You can be on top of Mount Everest and they still have to do a flood certification and make sure that the house is not in a flood zone. Tax service fees. Then, and you have what's called a New York State mortgage tax. Welcome to New York. The formula is 0.80% in Orange and Dutchess counties of whatever you're borrowing. The second part of closing costs is what's called the escrows, the money that the bank is holding back so that they make sure when the tax bills come out, they're able to pay those. So when you close, for example, if you were to close now and your first payment was May 1st, school taxes are levied in July. Bank wouldn't have enough money after you only made 1 or 2 mortgage payments to make it. So when you close, they're going to hold several months of taxes up front. So a simple rule of thumb for closing costs that I always tell people is double the taxes, add another 1,000 or 2, and that's about what you can expect. So if you had $7,000 in taxes on a home, I always tell people, I want you to think your closing costs are going to be about $15,000. And it's almost, it works like a charm almost every time. So whatever the taxes are, just double them, and that's going to give you an idea of what you're going to need for closing costs. Okay. All right, next slide. All right, so keep going. Let's keep moving on this. So what happens is, now that you have this information, here's what happens. Now that I know how much you're asked, how much you got to work with, what your credit score looks like, etc. Now that's when we could start playing with mortgages. I could turn around and say, like, hey, you qualify for, you have more than 10% down. You're putting 10% down. There's no need to go FHA or VA or Sunny Mae or Home Possible. You can go, if you want to put that much money down, then ideally what I'm going to tell you is go conventional. If you're limited on how much money you work with, Home Possible allows for 3% down. Now, these are links. And the reason they're there is because what happens is with Home Possible, you have to go, there's a Home Possible eligibility. And what happens is when you type in the address of anything you look at, it's going to tell you for that area what the income limit is. Because Home Possible, a lot of the first-time home buyer programs have certain income limits. So Home Possible will tell you based specifically on the location of that address what the average median income is. If your income exceeds that, your total household income, you're not going to qualify. All right, so that Sunny Mae is the same, but Sunny Mae has been generous. For example, the New York State program, you could do 3% down, but with the Achieve the Dream, one person can't exceed an income in Orange and Dutchess County of $89,000. If it's a household of 3 or more, it's $103,000. So it's pretty reasonable. They have another tier that's called the low interest tier. I just quoted the Achieve the Dream. And that one, for example, your income can't exceed $112,000. If it's a household of 3 or more, it can't exceed $129,000. Now, VA, FHA don't have income limits, but what I do want to say about FHA is it's 3.5% that you're going to put down. So a 96.5 loan to value, okay? But what I want you to realize, though, is if you do an FHA mortgage and you put 3.5% down, that PMI, that insurance that we talked about, they just lowered it to 0.55%, which is really good. The only thing is that it's lifetime. You can't get rid of it unless you refinance out of it, okay? That's the only negative. The positive with FHA is that they allow you to, if there's nothing out in the market that you're looking at, and let's say conventional, you're at 250, FHA will probably give you at least another $100,000 buying power. So that's one good thing about it. That's, that why people sometimes go that route. But I don't want you to think that it's necessarily just that it's the best avenue for you, because I might turn around and say, hey, look, you could do 3% with a Sunny Mae, but it's a 97% financing. The PMI will go away and you can get help with closing costs. All right. So that's important. And that's why I wanted you to understand that then we could start to play with the different programs and see which one works best for you. All right, next slide. All right, so go ahead. So the thing is, with any loan originator, don't be afraid to ask questions. I always tell people. And when you go, I did real estate for 20 years and I've been doing mortgages for 17 years, but don't be afraid to ask questions. But in this market, what happens is sellers don't want people going to the house. You call up a real estate agent, the first thing they're going to ask you, have you been pre-qualified? Okay. So your first step in buying a home is to get to any loan originator and get a pre-qualification. Right? You want to talk to them and you want to get the letter, because what happens is that's the first thing any realtor is going to ask you, is going to say, hey, before I go out and do real estate, I don't want to do real estate. I don't want to just carry you in my car and take you all over the place if I don't know that you can qualify for anything. So that's why they're asking you for a pre-qualification letter. I've seen many times, first-time home buyers get bent out of shape. I saw this on Zillow, or I saw this here and I want to see this yesterday. And they're going to say, did you talk to a bank yet? All right. And the reason for that is because they want to know you could buy it. Otherwise, they're wasting their time. Choose your agents carefully. So agents can be either a buyer's agent, a seller's agent, or what they call a dual agent. So what you want to know about that, and this is good because a lot of times you'll take a look at a listing and people have a tendency to call the person who's on the sign, which is okay, but make sure that that person discloses what their relationship with you is. In other words, are they only working for the seller? Because you don't want to open up your mouth and say, hey, you know, this house is on the market for 300. I'm willing to pay, you know, I'll offer 280. I'm willing to go up to 290, or I'm willing to pay 310 for it because basically you're tipping your hat. You know, so an agent might turn around and say, I want you to sign a dual agency, which means I'll represent you and the seller if the seller is okay with that. Or you can shop for an agent who's should be looking on your own behalf as a buyer's agent out for your best interest. Okay. Know your budget and comfort zone. I might qualify somebody and I might turn around and say to them, hey, look, your line in the sand is $400,000, but your monthly payment is going to be like, you know, $2,900, $3,000. And somebody's going to turn around and say, yeah, it's crazy. On paper, I could qualify for that, but I'm never going to be able to eat. So the thing to know is there's a difference between what you qualify for and what your comfort zone is. So know that. No, hey, look, I'm okay with it. If I rented a house, it's going to cost me $2,200 anyway, or it's going to, you know, or an apartment and stuff. So if I can own a home at that, I'm okay with it. If you're telling me I qualify for it, sometimes I'll get people and go, no, you know, you know, there's no way I can do this. I can't pay $2,700 a month. All right. So know that comfort zone. All right. And then just, you know, they always say research the home surroundings. Obviously, you know, you're going to live in a community. You're going to be part of the area. You're going to buy a home. You're going to be there for a while. So just make sure it's a place where you want to be. All right. Okay. So next, we're almost home. All right. Why Rhinebeck Bank? You know, we're local. We've been around since 1860. Mike Quinn, who's the CEO, just sent out a whole thing because people were nervous about banks and said, hey, we survived 5 major wars, a Great Depression, you know, we're still standing. So it's a great bank. You know, we have a lot of the products available that we discussed. I'm always like, for example, any of our originators around to answer any questions that you guys would have. We're having super turnarounds on stuff. You know, the processing and underwriting is moving really well. You know, I'm a firm believer. I always tell people, you know, ask me any questions anytime. Like, for example, even as you're looking for houses, if you want to know, once we start the original pre-approval process, I've got that information in there. So now if you saw a home and you like it and you know exactly what the taxes are, exactly what things are, you know, we could plug in those numbers and I can say to you, okay, that particular house, this is how much it's going to be. And I'll tell you also, you're good to go. Okay. So you will get $550, you know, a coupon that we're going to have towards closing costs. That'll help a lot. You know, that'll cover the cost even of the appraisal. All right. And next slide. All right. So there's the certificate and keep going. And, you know, normally I do this class for 3 hours and I've done them for Pat Stone in the past and stuff, but, you know, so I tried to cram in as much as I could for you and stuff. So, you know, there are probably a lot of other things I could have said, but I'm hoping that this gives you at least a base point, something you can go back to and look. I want to say one more thing too. The Sunny Mae has got a Give Us Credit program. If you don't have trade lines, it's very interesting. They just came out with a program this year that said, hey, if you don't have a credit score, and I did this already, as your debt if you give us a debt to income ratio of up to 40% on the back end, and you have 2 months reserves, or you can show a rental payment history of 12 months consistent on time, we will consider doing this loan, even though we don't have a credit score for you. And it's worked. It's a great program. All right. So, I mean, a lot of these things we can talk about all the nuances, and feel free to call me or communicate with me if you want to know more and stuff. But that's it, guys. So let's see if we have time for some questions.
I have a few questions that I took from the chat. The first one is, when the lender is looking to see if your PMI has changed, what is the process?
All you have to do is call the loan servicer. there's a person that you're paying the loan to. There's usually an 800 number and stuff. And what they will do is they won't just say, oh, okay, you think you have it, and reduce it. What they'll do is they'll say, if you're willing to pay the price for an appraisal, we'll send an appraiser out. And if the appraiser agrees with you, we'll get that PMI removed. Now sometimes people pay a PMI. Let's say, for example, PMI was $200 a month and it was added to that. Well, if you pay for an appraisal for $400, $450, and that gets rid of the PMI for the rest of the loan, it's like well worth it. But that's the process. Call the loan servicer, tell them you believe that you have 22% equity or more in your home, and you'd like to do the process of having the PMI removed. And it's a New York State law, by the way. They have to do it. There have been a few times in my life where I've heard people turn around and say, another lender, not us, oh, we can't do that. And I said, call them back, because that's New York State law. They have to do it.
The second question is Sunny Mae available nationwide?
No, it's a New York State program. It's State of New York Mortgage Association. So it's a specific need. It's specific for individuals in New York State.
Okay, third question. What are the current rates for mortgages?
It's a good question, and it's variable. I mean, here's one thing. A lot of times people will say to us, what's the rate? I'm going to tell you, like, for example, right now, Rhinebeck has a portfolio loan. And what that means is an in-house fixed rate mortgage and stuff, and as long as you meet criteria, and it's 6% right now. Here's the important thing, though. A lot of first-time home buyers go, okay, I want the best rate. If you call up another lender and you turn around and say, hey, Mike offered me 6%, you call a mortgage broker and say, can you do better? A lot of times people will turn around and say, it's very easy for somebody to turn around and say, yeah, of course, I'll give you 5.5. The second question you have to ask, which is really important, is for how much? So for example, the rate I just quoted is 0 points. So I just had somebody that did that. They sent me, and they said to me, hey, this guy's giving me 5.5. How come you do? And then I said, send me his loan estimate. He was charging $9,000 in points to reduce that person's mortgage to 5.5%. So I said, yeah, you give me $9,000, or Rhinebeck, not me, we probably can match that. But, that's what you have to be careful of. Just make sure you're comparing apples with apples when you're rate shopping like that. All right. Now, quick answer for you. Sunny Mae achieved the dream rate this morning is 5.625 without DPAL. If you don't need help with the down payment assistance, if you do take it, it's 6%, and that's the achieved a dream rate. Okay.
Who does the veteran have to be to qualify for a VA loan, especially if you're unmarried?
Well, if you're you could be reserves, or you could be retired, or military. You did military service and you have an honorable discharge in the DD 214. You qualify for a VA loan. Now, if you're not married, but you're living with someone, unfortunately, VA will not allow that person's income to be added in. You have to be a married couple in order to use a secondary income for a VA loan. Now, Sunny Mae has got a great program, guys. There's a link to Sunny Mae there. There's a program called Home for Vets. They allow you to have the DPAL and get the Achieve the Dream rate, and there's no income limit. So it's a super program. You got to remember with VA, it's 100% financing. However, VA, HUD, not us, charges 2.15% in points when you do a VA loan. For the first time. If you do it for the second time, it's 3.3. They take 3 points. What a point is a percentage of whatever you're borrowing. So they would take 3% of the loan amount if you're doing it a second time, 2.15% of the loan amount when you do a VA loan. I've done that Sunny Mae Home for Vets program. I love it. It's a great program as well. Okay.
Okay. Is a fixed mortgage better than one that may adjust over time?
Okay. So what happens is, ideally, right now, it's interesting. Traditionally, in the past, when the market and the rates started to increase, a lot of people started to consider. It's been a long time since people have considered adjustable rate mortgages. You can do that, but the thing is, right now, and I've had a couple of people inquire about adjustable rate mortgages, you'll hear the term 3-1, 5-1, 7-1, 10-1. What that means is when you get the rate, it's fixed for the first 3 years. And then whatever happens after that, you're at the mercy of the market. You know, most of them will say you can't go higher than 2% annually. But same thing with a 5-1, for example, 5 years, it's fixed. Now, the only time it might make sense if the rate is lower and you know you're going to get out of the house in 5 years. Right now, the adjustable rates are almost to par with the conventional rates, and it hasn't been making sense to do it. But so if the adjustable rates are lower, and for example, hey, I'm out of this house in 6 years and I'm heading somewhere else, then it makes sense. You may want to look into an adjustable rate.
Okay, the last question is, if I choose another bank, can I still get the $550 off the closing?
No, I mean, that's a program that's just with Rhinebeck, so we don't have the ability. We're not going to transfer that gift, or that coupon over to a different lender. We wouldn't be able to if we even wanted to.
Thanks, Deidre. And is there anyone that didn't get a chance to ask in the chat but wants to unmute now and has a question? Now's your chance. All right, back to Deidre.
Well, thank you guys. I hope you had enough information. Yeah, if you want to put my contact slide back, or I think you can get a copy of the presentation. You have more questions, feel free to give me a buzz. I'll be happy to help you in any way.
And Deidre, you're on mute if you want to close this out. Thank you so much, Michael. That was incredible. Like Jeannie said, I always learn so much, and I wish I'd had this before I bought my house.
And Michael, I don't know if you know, we were also streaming this and we had 50, 60 people on it as well. So that was good.
Wow, that's great. Awesome. You did good, Michael. Thank you so much. And thank you to Rhinebeck Bank. I know Tim Massey's hanging out here somewhere. So thank you very, very much. We appreciate it.
Yeah, and thank you all for joining us this morning.
Take care, guys.
Thank you all so much. Have a wonderful rest of your day. Thank you.